How's it going, everyone? I am Kobe Smith. I am a realtor with Chateau Seekers at Keller Williams Capital Properties. Welcome to our Q3 2026 real estate market update. I appreciate you all for joining us, and I hope you guys are able to leave with information on what's going on in the real estate market in DC, Maryland, and Virginia. And I'm also joined by Kevin Russell with the Mortgage Link, a mortgage lender with the Mortgage Link. I'll give him an opportunity to introduce himself once it's time for him to do his presentation. Pretty much what we're going to go over on this update is what's going on with loans and financing, how to go about getting loans and financing. We're also going to discuss what's going on in the real estate market in the sense of what's going on with inventory, what's going on with home prices in DC, Maryland, and Virginia. Also, how that affects you as a home buyer, as a home seller, and as an investor.
Hi everyone, Kevin Russell with the Mortgage Link. I'm a loan officer here. Looking forward to going into the information today. All right, so like we said, this is the quarterly market update. I attached a graph here of the last 12 months or so in the interest rates. So as you can see, this wasn't the best quarter that we've ever had for interest rates, but we're kind of in the same ballpark that we've been in for the last couple of years here. As you can see right here, in March, that's what everything kind of started with Iran. And that's really what's been fueling these higher rates than where we were to start the spring market. So that's really been leading to these higher interest rates from where we were last quarter and at the end of Q1. So that's where we're at right now. So right now it's probably in between about 6.5% and 7%, but every single person's interest rate is going to be a little bit different. This is just like the average interest rate. So depending on which your credit score, your down payment is going to be, what loan program you have, whether you're a first-time home buyer, it's going to be a little bit different than what you're going to see as this like exact average rate. But this is just the trend of where we've been over the last 12 months. And a lot of people kind of want to know what actually does control the interest rates. And everyone thinks it's the Fed. The Fed is who controls the interest rates. And it's actually a little bit different from that. The Fed really controls short-term monetary policy. And so that can influence the interest rates. But when you see like a 1/4% interest rate drop by the Fed or a 1/4% interest rate increase from the Fed, that's not a one for one. That means interest rates are now a 1/4% higher or lower for the mortgage rates. It's a little bit different than that. What really actually controls the interest rates and what's been the biggest factor for us recently is going to be inflation. So as inflation goes up, interest rates typically go up. As inflation goes down, interest rates go down. You have the economic growth and the job growth. And this might be a little bit counterintuitive, but it goes hand in hand with inflation. So as the economy really picks up and if everything's going really strong, that actually is going to make interest rates go up a little bit as well, because then you have the concerns of inflation. It's the same thing with job growth. So as jobs, actually, if you see unemployment went down, that actually usually means that rates could go up because it's the same concern with inflation. So it's kind of, you wouldn't think that you'd be like, oh, the there was higher unemployment this month. That's actually not the worst thing for interest rates. And then lastly, you've got the investor demand for mortgage-backed security and treasuries. So this actually does follow very, very, very closely. So typically when you see like the treasury bonds, if their rates go up, mortgages are going to really follow. If the price for the mortgage bonds go down or the treasury bonds goes down, the mortgage rates are going to follow as well. So getting into with the slightly higher interest rates for this quarter, a couple strategies to help with affordability. Depending on what your state, most states have different local down payment assistance programs. For example, in the state of Maryland, you've got all of the Maryland mortgage programs. For DC, you've got the DC Open Doors, different things like that. As well as different counties can have different down payment assistance. Like Montgomery County has one, PG County's got one, Frederick County's got one. So those can be really good local programs to look at as well, that it's going to make it a little bit more affordable to get into the home without requiring such a big down payment. You can also look at temporary and permanent buy downs. So you can do what's called like a 2-1 buy down, which means that the first year you're in the home, the interest rate is 2% lower than what your rate will be for the long term or what it would normally be. The second year, it's 1% lower. And then years 3 through 30, it's going to be the rate that you're at. So that can kind of help in the short term, make your monthly payment be a little bit more affordable. Another option is seller concessions for your closing costs. And that's going to be there where they can help pay some of your closing costs to help you get into the home without having to bring as much money out of pocket. Typically, your closing costs are going to be about 3-4% of the purchase price of the home. And different programs allow different amounts of seller concessions. But like for example, in an FHA loan, you can try to negotiate up to 6% of your closing costs paid for by the seller, which is going to be pretty much all of your closing costs, and you might be able to even buy down the rate a little bit. And it's the same thing with the lender concessions. Um, it's not going to be available every time, and if your debt to income ratios are really close, it might not make the most sense. But you can always take a slightly higher interest rate to pay some of your closing costs and have the lender pay some of your closing costs. It's kind of the opposite of buying down the interest rate where you're paying to lower your rate. You can actually get paid to take a higher rate. So the steps that you should be taking when you're preparing to buy is you want to know your credit. So where's your credit score at? And beyond the credit score, what's on your credit report? Do you have a bunch of collections? Is your credit card debt high? You want to know these things when you're preparing to buy because that's going to put you in a tougher position when looking to buy a house if those things are there. Along the lines of credit, you also, when you're looking to buy a house, it's not the time to buy yourself your new Mercedes Benz and open up a bunch of credit cards and things like that. You really don't want to be opening up a whole bunch of lines of credit when you're looking to buy a house because that can affect what you'll be able to qualify for. And then part two, you're gonna want to know your budget. And budget doesn't just mean I know that I want to buy a $500,000 house or $600,000 house. You want to be able to know what you can pay on a month-to-month basis, as well as what you feel comfortable paying out of pocket at closing. And so this lends really well with meeting with a lender. So you're gonna want to talk to a lender. You're gonna want to get pre-approved, and who you work with is really important here. Before you buy a house, you don't want to just verbally tell the lender, this is how much money I make, this is what my W-2 looks like. You want them to really go deep into this is what my pay stub looks like, this is my assets, this is what we're looking at here, because there's so many things with mortgages that you need to be paying extra close attention to. For example, let's say you make $80,000 this year, but this is the first year you've gotten overtime and you've gotten $30,000 in overtime. Overtime has to be averaged out over 2 years, and if you haven't received overtime before this year, you can't use that income. So it's really important to not just know this is what my total income, but how is the mortgage company going to look and qualify my income? And then getting pre-approved. This is the number one most important step. No seller is going to take your offer seriously if you haven't been pre-approved. And that doesn't just mean that they've like ran your file through like automated underwriting system. You actually want a real underwriter who's going to approve your file to look at your loan before you get under contract and make sure they're seeing it the same way that the loan officer is seeing it. Because they're going to be the one that actually is going to be approving your loan, and you want to make sure that when you write this offer that you're confident and the sellers are confident that you can close. And so this is the steps to get pre-approved. You've got to complete the application. The application basically goes over your last 2 years of job history, your last 2 years of where you've lived, your bank statements, your credit scores, and all of that. You're going to submit supporting documents. So things like your W-2s, your pay stubs, your bank statements, could be tax returns, that sort of thing to support what you're seeing on the application. You're going to review different programs that you may qualify for. There's a lot of misconceptions out there about which program is better, which one makes the most sense. Every scenario is a different scenario. And so you want to talk with a professional and figure out this is the loan program I want to be in. Makes the most sense for my monthly payment and for my long term and short term. And then submit, like I said, to underwriting for approval and have an actual underwriter look at it. And then just a couple common mortgage myths. I need 20% down. That's obviously not true. Depending on the loan program, you can do as little as 20 or as 3% down for a conventional loan, 3.5% down for FHA, and you can do 100% financing for USDA and for a VA loan. And beyond that, you have programs like I was saying with the Maryland Mortgage Program before. You can get up to 6% of the loan amount from the state. So that means if you can combine that with getting some seller closing costs, like you can come to the table with very, very little. You need a 700 plus credit score to get approved. That's not true at all either. For an FHA loan, you can go as little as 580 if you're going to put down the 3.5% down, and as little as 550 if you're willing to put down at least 10%. So 700, definitely not necessary. It'll help your interest rates and your qualifying purposes, but it's definitely not necessary. I should wait until rates fall. And this is something that's really, really common. And a lot of people say this, and I talk to people all the time, and this is something that always comes up. And I think that the biggest thing that you need to realize about waiting for rates to fall is that when you see the rates fall, it doesn't just fall for you, it falls for everybody that's been waiting for rates to fall. So, yeah, you might have a slightly better interest rate, but if you're having to put a $30,000, $40,000 higher purchase price, your payment's going to end up being the same because you're drawing off of the same amount of principal that you're having to pay down. So it is a really common saying in this industry, date the rate, marry the house. If rates fall and you were able to qualify with the higher interest rate, you're just going to have that much better of a payment down the line. And you're going to be paying off a lower principal amount. Versus if you wait until then, you're going to probably be in a bidding war for all the people that haven't been able to buy when rates were higher or people that were just waiting for that. And then the lowest rate is always the best loan. Now that seems like it should be an obvious, yeah, obviously I want the lowest interest rate, but there's other things to factor in. One thing to factor in is going to be, am I paying for this interest rate? So you might have someone charging you 2 points to get this interest rate versus someone's not too far off and they're not charging you anything. It might not make sense to do that. It may, but you really have to look into it. How long do you plan to be living at this house? Do I think that interest rates are going to fall soon? Do I think that they're going to stay pretty stable for a couple years? And then you also have your mortgage insurance. So mortgage insurance is going to be different on a conventional and FHA loan, and the interest rate's going to be different. The mortgage insurance on a conventional loan is tied to your down payment amount, your credit score, and what your debt to income ratios are. For the FHA loan, it's just strictly on your down payment amount. So if you have an 800 credit score or a 620 credit score, your mortgage insurance is going to be the exact same. So you might end up paying less on a conventional loan because you have such little mortgage insurance in besides an FHA loan because the mortgage insurance might be higher. The other way, you might have the better interest rate on FHA and better mortgage insurance on FHA. So in that situation, it would be better, but it's not always.
I appreciate you, Kevin, for your amazing presentation. If there's any questions, feel free to throw them in the chat. I'll go ahead and move forward to my presentation about what's going on specifically in Maryland, DC, Virginia when it comes to housing, home prices, um, inventory, what else? Locations that people should pick, and what buyers, sellers, and investors should be looking for. Let's go over Q3 2026 real estate market update, talking about interest rates, affordability, and competition. So, like I said earlier, my name is Kobe Smith. I'm a real estate and realtor and real estate developer in Maryland, DC, and Virginia. I also own a team called Chateau Seekers at Keller Williams Capital Properties. And my main focus pretty much is I'm very community involved. I'm president of the Greater Baltimore Leadership Association, and I sit on the board of the Greater Baltimore Urban League and Greater Bethesda Chamber of Commerce outside of real estate. And then I'm also the co-chair of the real estate committee with the Bethesda Chamber of Commerce. And the mission of my whole real estate business, Chateau Seekers, is helping people build wealth, create opportunity, and turn dreams into a reality through real estate. All right, so the purpose of today's session and what we'll be discussing is what changed since our Q2 market update. Maryland, Washington, D.C., and Northern Virginia market conditions, home prices, inventory, days on market, and buyer demand, where buyers and sellers have leverage, opportunities for buyers, sellers, investors, and what could shape the market heading into 2024 and Q4 of 2026. So, going from Q2 to Q3, what changed? Home prices elevated, inventory is constrained still. Buyer demand is selective, and negotiation is there's more room for negotiation. So pretty much we've entered from Q2 to Q3, we've entered a um, spring summer market. Normally, historically, spring summer markets are usually higher demand because students and get out of school, families looking to move because they have a little bit more time and flexibility to move around. So this is why usually see home prices go up in these times. Usually see um, more sellers and more buyers during this time of the year. But when you're in like the winter time, you usually see less buyers, less demand, less competition, but you're still able to find a um, good properties out there, but there's just less opportunities if you're a buyer. Same with as if you're a seller in that market, there's less buyers out there for you to find your listing. Whereas in the summertime, there's more buyers, more sellers. Um, Buyers currently are selective, as it says. We buyers currently are looking for affordability. They're looking for space. They're looking for bang for their buck, but also not to break the bank. And then when it comes to negotiations, on most properties listed right now, you might see two, three, a couple other offers, a couple offers you might be competing with if you're a buyer. If you're a seller, you might have a couple offers, but there's not as much room to negotiate as there was, let's say, just after COVID or in COVID, where you're dealing with like 10, 15 offers on your listing, or you're competing against 10, 15 other offers when you're a buyer. So the bottom line here is we are moving towards a more selective and balanced market, not necessarily a cheap market. So, the DMV market at a glance, and I'm going to go deeper into the DMV market, but this is it at a glance. For Maryland, you're seeing supply constraint. For DC, you're seeing neighborhood specific. And for Northern Virginia, you're seeing demand driven. What does this mean? In Maryland, supply constraint means that there's limited inventory supports prices. This means that if you look at the comptroller's data that she put out this year, she kind of breaks down the inventory in Maryland. We're currently building around 12,000 homes per year. We need to be building around 36,000 homes per year. So there's a gap right there that we need to, oh no, it's not 36, with 30,000 homes per year. There's a gap right there of 18,000 homes that we're missing out on. And that means that there's less inventory on the market, causing home prices to go up, causing more competition on homes. So we're not meeting the buyer demand when it comes to inventory. That's what we're seeing in Maryland, the supply constraint. When it comes to Washington, D.C., you're saying that it's very neighborhood specific. Specific property types, specific locations matter more in DC right now. When it comes to Northern Virginia, you're seeing it's demand driven. There's employment opportunities in Virginia. There's transit supporting demand in Northern Virginia. There's a lot of opportunity going on in Virginia right now, and it's driving a lot of the buyer demand. There is no single DMV market. Your experience depends on your location. So whether you're in Maryland, whether you're in DC, whether you're in Northern Virginia, each area is different. So you need to make sure you have an expert that understands each area when you're out there looking for your home or looking to sell your home that understands the area that you're looking in. When it comes to Maryland specifically, for the Maryland market update, the median sales price in Maryland as of May 2026 was $454,000. That's up 33.2% year over year. The average sales price in Maryland is around $547,000. That's up 4.7% year over year. The median days on market is around 10 days on the market. And the months of inventory is around 2.8. Supply remains constrained. So what this median sales price, what this means is all across Maryland, the majority of homes, leaving out outliers, are selling around this price point. So if you're a home buyer in Maryland, you should be looking for, of course, something that you can get pre-approved. You need to talk to a lender to figure out what you can get pre-approved for. But to have the most opportunity and most options, you should be looking around that price point. For the days on market, we're seeing 10 days on market. It's that's a little fast for homeowners, I mean home buyers, because if you think about it like this, a home buyer, you get pre-approved, then you go out that next weekend. If you see something on Thursday, then if something hits the market on Thursday, then it usually takes 10 days for it to close if it's priced well. There's a lot of stuff that, of course, isn't priced well, but this is the median, focuses on stuff that's priced reasonably. And then you have the months of inventory, which is 2.8 when it comes to supply remains constrained. So pretty much also as of May 2026, we were seeing 6,331 homes sold. That's down 2.8% year over year. And the key takeaway from Maryland's market is that prices can remain firm even when transaction volume slows. So the reason why prices remain firm is like what I mentioned earlier, that there's so little, we're not keeping up with demand for, and when it comes to inventory, that's why prices can remain firm. Instead of you seeing that prices are getting lower because there's still not enough homes out there to meet demand. So why Maryland is different? When it comes to active inventory, we're down 16.4% year over year. When it comes to new listings, we're down 22.1% year over year. When it comes to pending sales, we're up 9.6%. And when it comes to showings, we're up 4.6%. Pretty much what this means is that when it comes to active inventory, new listings, that's pretty much talking about what stuff's coming to market. And the fact that all this is down in Maryland is just shows us that we aren't keeping up with the inventory, whether it's new developments, whether if it's already pre-existing homes being sold. Um, there's not enough inventory on the market in Maryland right now, keeping the prices going up. When you're a seller, you love to hear that because that means your home prices continue going up. But when you're a buyer, then it might cause you to be priced out of the market. Or it might be more competition when it comes to competing for a home, or less opportunities when it comes to competing for a home. When we see pending sales up 9.6, that means that when stuff's hitting the market, a lot of stuff is closing. A lot of stuff is going on a contract. A lot of sellers are finding buyers. That's because there's still buyers out there. There's just not a lot of sellers. And when it comes to showings, you're seeing showings are up 4.6%. And that's also because there's so little inventory. You have a bunch of buyers that need to go see the same properties. So limited supply plus continued demand equals continued price pressure. When it comes to Washington, D.C.'s market, the D.C. market remains highly segmented by neighborhood and property type. Condos and single-family homes can behave very differently. Buyers are increasingly price sensitive, and walkability, transit, and access to amenities continue to matter. Properties require work face greater buyer security and currently correctly priced, well presented homes can still be competitive. So this means when we're talking about the DC market remains highly segmented by neighborhoods and property type, we're pretty much saying is that DC buyers, they're looking for specific neighborhoods, they're looking for specific property types, they're looking for more space when it comes to single family versus condos. They don't necessarily want to have a smaller condo, especially when it comes to like one bedrooms or one baths. There's less demand out there for that versus a single family that has two, three bathrooms with multiple bedrooms where families and couples and more people, and there's more demand for buyers. Also, when it comes to the whole DMV, people are looking to be close to work. People don't necessarily want to have to worry as much about the commute, even though if it comes to affordability, people are willing to deal with that. We're also seeing that they want to be able to walk around. They want to be close to transit. Those are usually the economies that are booming and bustling a little bit more, creating a stable, more security when it comes to the equity in your home and your home's appreciation. So we're seeing that buyers are getting more educated on picking their areas. So want to keep that in mind when it comes to dealing with DC's market. When it comes to Northern Virginia's market, we're seeing strong employment centers and high household incomes continue to support demand. You're seeing metro and commuter access remain important value drivers. Desirable communities still face limited inventory. More choices do not automatically make every property negotiable. Well located, correctly priced homes can still move quickly. And pricing and presentation matter as buyers become more selective. So as we're seeing and as you are hearing, across the whole nation, there's housing affordability crisis, there's a housing inventory crisis, and Northern Virginia is also experiencing this. Maybe not to the extent that Maryland's experiencing this, but they're still dealing with it. You're also seeing that people still want to be by metro in areas where that they can get to where they need to be, whether that's work, whether that's lifestyle, whether that's a gym and all that type of stuff. They want to be able to around that. They want to purchase homes around that so that they can be close to where they want to be. They're also seeing that that there might be sellers getting multiple offers, like I mentioned earlier, two, three offers around around these markets right now. But that doesn't necessarily mean that the seller or the buyer have as much wiggle room to negotiate. Because you might have, let's say you have an offer that comes in at ask, and if you're on the buyer's side, you kind of have to you're competing against the other offer, but every buyer, home buyer is educated, especially if they're dealing with a good realtor, they're educated on what's going on and what they don't want to compromise their security and their goals to just purchase any home. So that's what we're seeing when it comes to negotiation. So who has the leverage? Buyers gain leverage when a property has been sitting, the seller intentionally overpriced, the home needs repairs or updating, there are a few competing offers, and the seller has a strong motivation to move. When it comes to sellers, inventory is limited, the home is priced correctly, condition and presentation are strong. The location is highly desirable, and multiple buyers want the same property. So the bottom line is leverage is property specific, but there are strategies to go about maximizing your opportunity, whether you're a buyer or you're a seller, to getting your home as a buyer or winning a bidding opportunity as your buyer, versus also being a seller and getting multiple opportunities and getting multiple offers and selling your home at a price that you're comfortable with. There are ways to go about winning. So, opportunities for buyers: negotiate purchase price when the property and seller situation create leverage. Ask for seller credits when appropriate, whether that's talking about seller credits for the inspection contingency. Let's say you go into a home, your inspector comes back with repairs, and you have the right to negotiate. Make sure you go about dealing with those repairs in a way that you might get seller credits. Make sure you negotiate for seller credits when it's appropriate. Use inspection and property conditions strategically, like the example I just talked about. Consider homes with longer days on market or recent price reductions. Stay prepared. Desirable homes can still attract multiple offers. And be patient when you have leverage and decisive when the right property appears. Opportunities for sellers. Price the property right. In today's market, not yesterday's expectations. A lot of times when I'm going on sellers appointments, a lot of sellers go in with pre-existing expectations on home sales, and that is great. You want to understand what's going on. You want to have an idea of what you like, but also it's really important to make sure that you take a comparative market analysis seriously. A comparative market analysis, what that does is take the sold homes in the area in a mile radius within the last 6 months, and it gives you an idea on the median, the average sales prices for properties that meet your property's criteria, whether that's bedrooms, bathrooms, square footage, how updated it is. Make sure you take that seriously because then you're able to understand what's going on in the market based off that, and you're able to price your home in a position where buyers are buying homes in the market versus just looking on Zillow and seeing homes that, oh, this home's active for this price and it's right around the corner. This home might not be the best comp for your property. Or this home might be active, but the seller might have overpriced it. So now you're both sitting on the market. So make sure you take a market analysis of the property seriously so that you can price right and you can get your home sold instead of just sitting on the market. Presentation is important. Make sure your presentation, what are the photos that you have on the MLS or on Zillow, on Redfin or Realtor.com, make sure those photos are professionally done. If you need staging for your property, then make sure you get it staged. If you need video, make sure all the marketing and all the presentation of your home, whether it's curb appeal, any of that stuff, make sure it looks good so that when home buyers see it, whether that's online or in person, they come to your property and they're like, okay, this is somewhere I could see myself living, and this is something I can work with so that you can attract even more eyeballs to your home and even more opportunities to sell and even more offers, and give yourself more opportunities to actually pick between offers. Positioning is important. Understand the alternatives buyers are seeing. So know what other competition is out there that you're competing with on the market. And so you can price accordingly. Negotiation is important. You should be looking beyond the purchase, beyond just the price. Because let's say that you are selling a $400,000 home and you've just looked at a $400,000 home, but you didn't take into consideration any of the other closing costs associated with the home sale. You haven't taken any consideration of what an inspection or credits might look like, or the home buyer's potential loan program. You haven't taken any of that into consideration. You have to look beyond just the purchase price to find the right offer to make sure that you can get to closing. Because let's say a cash offer that can close at your list price might be different than another offer that can close at your list price, or a FHA or conventional offer that can close at your list price. Because that cash offer might be talking about, well, I can close next week, I can close right now, versus conventional or FHA might take a few 20, 30 days for you to get there. So you understand what the offer is actually presenting beyond the list price so that you can make the best decision on what you are looking for in a home sale. The market can still reward sellers, but is increasingly punishes overpricing. So opportunities for investors in this Q3 market. Look for properties sitting longer than competing listings. Watch price reductions and value add opportunities. Follow areas benefiting from infrastructure and transit investment. Prioritize properties with multiple potential exit strategies, whether that's renting, whether that's doing burn method or fix and flips or refinance. Understand your exit strategies. Favor locations where housing supply remains constrained, and underwrite conservatively purchase price, renovation, rent to cash flow, rent strategy, long-term demand. So, areas to watch when it comes to um, good investments or areas to be looking at. Transit investment. Connectivity. Your transit investment is very important to look at because areas with access to transit usually show that the economy is a little bit more booming, a little more bustling. There's opportunities for there's job opportunities, there's all that stuff. People areas like investing in areas with transit investment. Whether that's Metro, whether that's Mark, whether that's Purple Line. Look into infrastructure investment, whether that's public and private improvements. Look into limited supply, scarcity, demand exceeds available housing, and relative affordability, entry points, value versus nearby markets. Also, watch employment growth in major job centers that support long-term housing demand. What I'm watching going into Q4, inventory. Will more homeowners finally list? Demand. Will affordability continue to limit activity? Home prices. Can limited inventory continue supporting prices? Days on market. Will homes take longer to sell as we enter fall? Price reductions. Are sellers adjusting expectations? In local development, where are transportation, housing, and economic investments creating opportunity? How should you position yourself as a buyer? You should prepare, analyze, and act. Know where you have leverage and make sure as a buyer, you go ahead and get pre-approved when you start thinking about it or talking to a lender so that you understand your financial situation, whether you're a buyer or an investor, you understand your financial situation and you can take that time if needed to raise your credit or lower your debt to income ratio. Position yourself so that you can put yourself in a position to purchase asset, a home, a property that meets your goals. And if you do it earlier, you'll be ready by the time it's time for you to purchase. When it comes to sellers, you want to price, you want to focus on price, you want to focus on preparation and positioning. You want to make sure that you present a listing to the market, whether that's in coming soon phase or whether that's an active listing. You want to make sure you present a winning listing from day one. As an investor, you want to make sure your underwriting's in check and you negotiate very well. You need to be thinking long term, not just what's going on today. And for everyone, make decisions based on your situation, not headlines. So the market is only half the equation. The market tells you where opportunities may exist, where competition is stronger or weaker, where pricing and negotiation are shifting. Financing tells you how much you can comfortably afford, which programs may fit your situation, and how to structure the purchase. So, you guys heard from Kevin Russell earlier, and he went over mortgage rates, affordability, and financing strategic pre-approvals. And I hope you guys were able to gain something out of that presentation. Next steps, pretty much after this call, will be take some time to figure out your goals in your timeline. discuss your current real estate position, identify opportunities and potential risks, create a personalized action plan, and determine your next steps. And what I will do, and I will send out email to everyone that registered for this call so that we can set up a one-on-one meeting with me, Kevin, and then also you all to go over what your goals are and kind of put together a plan where you can actually make sure that you can achieve those goals that you look to achieve, whether that's next month or whether that's a year or two down the road. We can make sure that you're able to have a plan in place so that you can move forward. So I appreciate everyone for joining us today. I'm going to go ahead and stop the recording. And Kevin, thank you for hopping on this Q4 market update and Q3 market update this today, and for presenting and sharing your knowledge with our crowd.
Yeah, thanks for having me, Kobe.